So how do we improve the liquidity of the asset management market? Well, we need, I think, transparency into fees. We need transparency into not just the returns, but also the investment processes.
I think first and foremost with fiduciaries, we think about the long-term interests of our clients. And so when we're thinking about the challenges they face in liquidity, we need to think about how we organise our business, but also how we're constructive with regulators about some of the changes that they're proposing, so that they understand there's a perspective that's not necessarily coming from banks, but coming from those who represent the interests of long-term savers. I think we can be very constructive in that dialogue.
Liquidity is typically provided by the large sophisticated asset managers. And so if we can improve investors' ability to find the good asset managers that really have their abilities to source returns, then those asset managers will be better capitalized and they can trade more efficiently and improve the liquidity in the security markets. So improving the functioning of the asset management market could really improve the liquidity in the security markets.
There are really positive changes like technology that can put us in a better place. And I think if we look through the lens of trying to get back to some era before the crisis, I don't think that'll be successful. So I think we need to be a little careful about that and look forward and think how we can use technology to make things better, different but better.
So if with the new information technology we can improve investors' ability to really look behind the veil and figure out which asset managers are really working very hard to create returns and which are mostly just collecting fees, I think that then there's hope that investors can get value for their money.
There are one or two areas in which regulators can assist the provision of liquidity. One of those where efforts are ongoing is to improve the availability of market-making services on off-dealer balance sheet vehicles like trade platforms or matching sessions.
Regulators, again, may need to think about creating a more heterogeneous system where people have different appetites for liquidity and can substitute for some of the occasional gaps in liquidity that we're seeing through what has become a little bit more of a homogeneous system.
Another way to conserve dealer balance sheet space and maintain liquidity is through the creation of central counterparties, especially in the repo markets, where in the United States there's been a lot of concern about repo market liquidity. A central counterparty could mitigate that quite a bit.
So I think for regulators, the issue they have to think about is to understand, if you like, the distribution of liquidity shocks. And the problem for the regulator is to think about those circumstances and to plan on those circumstances.
Another area in which regulators can make a difference and have been making a difference is in bringing together capital markets participants, academics, and other policymakers into the same room to have conversations about these issues.
Well, I think structural issues are very important. I think in addition to that, to weigh carefully the benefits of a more resilient system against the costs of diminishing liquidity, and to really be careful about that balance in the interests of investors and also issuers of securities to ensure that liquidity premia doesn't rise to the extent it starts to have an impact on the real economy.